And y'all, we are so excited about today's guest. Today's guest is Scott Weavil, and Scott is an expert in M&A in the lower middle market, or another way to put it is smaller to mid-sized companies. We're thinking revenues between 5 to 50 to 100 million, that privately owned enterprises that are looking to either execute an M&A strategy, so they're looking to acquire businesses, or they're looking to sell and exit or just transition their business. And Scott is an absolute expert in this, and so we are so excited. But just wanted to give fair warning to our audience today that this episode was recorded using our old podcast name, Accelerating Lower Middle Market Value. And we found that name to not be very enticing, not to be very fun and relatable, and we decided to rebrand to Brewing Business with Brady. So I just wanted to give a quick shout out that you're going to hear references to our old podcast name, but nonetheless, the episode is filled with a ton of jam-packed advice for you. And so we hope you enjoy. Thanks. Scott, again, thanks so much for being here with us.
Yeah, absolutely. Happy to be here. And thanks so much for the warm welcome.
Awesome. Scott, yeah, I think it's really great that you actually understand what the lower middle market value is, right? That we're interviewing a lot of business owners, and yeah, they're in the lower middle market. They don't always have that perception as to, okay, they are in the lower middle market. And so it's great to talk with somebody that really understands what the definition of that really means, right? But yeah, I'd love, for our audience to understand your journey from being an M&A attorney to founding Sierra Pacific Partners. Can you elaborate on that for us? Give us a little bit of the origin story.
Yeah, for sure. I always thought that moving more towards the finance side or investment banking would be interesting. And that was a pretty common path when I started work on Wall Street in 2008. That will tell you something right there about why that didn't work out immediately.
Yep.
Prior to 2008, a lot of folks did go to the larger law firms, work a couple of years, and then end up at a bulge bracket bank. As of 2008, that opportunity was basically foreclosed. So I ended up working as an M&A lawyer for a long time, a corporate lawyer. And a few years back, I had a client that I was serving on a legal way. And he basically just could not find a banker or broker that he liked to sell his business. There were a number of reasons for that. And there were a number of reasons why bankers and brokers weren't interested in working with him. He had some unrealistic expectations.
Got it.
But at the end of the day, which didn't affect me on an hourly basis. So at the end, as a lawyer, so at the end of the day, I ended up running a sell side process for him. Not the financial aspects, but basically reaching out to buyers, getting them under NDA, helping out with negotiations and things like that. It was about, we got very, very close to a deal. It was going to be about a $40 million deal for a manufacturing business, and it was pretty fun. But it exploded at the end like deals sometimes do.
Wow.
But I just really enjoyed being more central to the process in that. And so it got me to start thinking maybe, hey, I can just go out and start my own firm, just wearing a different hat, something that I've been doing for 15 or so years with a slightly different hat on.
Well, yeah, that's really great that, you had that experience, Scott, that, yeah, I've experienced too, and being a part of M&A processes. It's just such a unique dynamic process, and having to manage different party expectations. There's a lot of that negotiation that takes place, and so I can definitely see why you were enticed by it. That, yeah, there's something to it that so dynamic, and the reality that the deal may not go through, and a lot of people don't get paid if you don't have the deal go through, so you do have to tightly manage it and try to bring it to success. And so that's great. Well, I'd love to understand for our audience, how does Sierra Pacific Partners, how does it differentiate itself in the lower middle market M&A advisory space?
Yeah, for sure. I mean, I think there's several things that sort of differentiate us. I've been in M&A for over 15 years, including at the highest level. And I don't think that necessarily means much with regard to we're doing super sophisticated financial analysis or commenting on the documents. I mean, it definitely has something to do with that. But what I really mean is that that's to indicate a level of responsiveness and professionalism that I think we always try to deliver to our clients. We're somewhat unique in this space in that we use what I'll say largely success fee driven pricing for committed sellers. I am a former lawyer, so I'm going to give it some caveats. If I think you want me to work for a year, but you're really not interested in selling, I'm probably not going to do a success fee only driven deal. Yeah. But I think it's important for folks to realize in the space that typically, unlike business brokers, where sort of like if you're selling your house, you agree to a purchase price, And if the business broker brings that a buyer at that purchase price, whether you sell it or not, you get a commission. That's not how it works in the middle market. Generally, you're under no compulsion to sell or pay a fee at any time. And so as a result of that, most advisors will charge monthly retainers, or they'll charge startup fees coupled with milestone fees, such as upon selling, signing an LOI or something like that. But we try to keep it solely success fee oriented, because honestly, I'm not going to go after somebody and sue them for not closing with a counterparty that they didn't really like, for sure. And so at the end of the day, if I know I'm going to be if that's where we're going to end up anyhow, might as well start that way. And again, I'm not here to make to make money off retainers and things like that. I'm here to get to a closing, if it makes sense. Again, yes, the compensation is incentivized towards that way. But I think most of us that play in this market, absolutely, we're looking at all the factors, and we do not want to see folks close bad deals.
Got it. Let's take a step back here too, that we've defined for our audience are what we feel is the lower middle market. How would you define the lower middle market? I know that, it's like we both went through the CMNAA and they say roughly 5 to 50 million, but what are the characteristics of the lower middle market that you think are important for our audience to know?
Yeah, for sure. I mean, we can talk about the quantitative characteristics, right? Like something like 5 and 150 million in revenue, 1 to 25 million or so in EBITDA. I'm sort of thinking, probably $5 to $100 million ish in purchase price, and realize that even that we're talking about grossly different things. $150 million revenue probably does not have a ton in common with a company with $5 million in revenue. Yep. But I think what makes the lower middle market interesting is we're seeing a blend of features from what we'll call Main Street. So let's call that below 5 million in purchase price, something like that. And the true middle market, which includes some truly big companies that honestly could be public companies if they were, if they so chose to be so. So we're talking about things like owner dependence. We're not seeing typically the day-to-day owner dependence that you would see in a Main Street company. However, we aren't seeing a separation from ownership and management. What I mean is most of these lower middle market companies, the CEO is still one of the owners. It's not, the ownership is not totally divorced from management. We're still seeing, we're typically not seeing a lot of multi-layered management, meaning, that owner doesn't have too many folks between him or her and those frontline employees, I think is a feature. And we also look at decisions being made, and I don't mean this is in a bad way at all, but not driven solely based on economics. So one of the things that I know from talking to tons of owners is, yeah, they care about the purchase price. They care that, the deal terms are going to make that purchase price relatively secure, but they also care about their legacy. They care about their employees, and they care about all kinds of other factors that if you are solely an economically rational actor, you don't necessarily bring into play as much. And I think that is a huge difference between the lower middle market and the broader, as we move up market past that.
Yeah, that was a great listing of characteristics that, like you said, that I think there's truth to it, right? That you can have somebody at 5 million. I tell people this, that you can have a general contractor that goes and gets one job in their first year that books $5 million in revenue, but that doesn't necessarily mean they're a lower middle market business. That means they are still a small business, and so having some of those characteristics is really healthy.
And for sure. And we've got one in the pipeline right like that right now. They're actually a contractor doing above $40 million in revenue, but their operating characteristics are much more like a Main Street company. And in fact, that's what it makes this a wonderful opportunity, if I'll put my pitchman hat on, is that this is a perfect play for the private equity MBAs to come in and run the business while our seller is out there doing what he does, which is selling that revenue.
Yep, totally. Well, you kind of spoke, you did, it's not that you definitely spoke a lot about your success fee structure and how, you really want to work for success for the clients rather than just a retainer structure, right? So yeah, I'd love to hear a more recent story of success. Like, give us an example of a recent success you've had with a client and exiting well, and a little bit of background about that.
Yeah, for sure. We sold, I should say we're industry agnostic and work across the United States. So you'll hear me talk about construction. I'll talk about health tech. I'm about to talk about SaaS. And there's some reasons for that. the first one is I find it fun to work in different industries. And
Yep.
it's also good to sort of be able to cross apply things you see in one industry that are pretty typical to another industry where they may be more novel, but may provide a solution. But earlier this year, we sold a SaaS company and it went really, really well. There were unusual characteristics. It was not high growth, but it had steady ARR.
Got it.
But the kicker was it was essentially passive. I know we talk a lot about that. You see a lot of posts, make $1 million a year without doing anything. And most of that is candidly discounted, and it should be. But
Yep.
this owner literally was working 4 or 5 hours a week and making pretty good money. So because of that, he had a very high opinion of value because his view was the opportunity cost of keeping this thing is low. So if I don't get my price, why would I sell? We
Yep.
were able to get him to a great exit. We had multiple buyers along the way. We had some financing hiccups, not because of the business, but just our buyer was shopping rates and things like that. But I think what really helped us be successful with that was number one, the owner's patience. I talk about this all the time, but it's sort of like anything in life. You can't want the perfect buyer at the maximum price and as fast as possible. Those three things don't mix. You sort of have to optimize for the three in combination. And so the seller was patient. He waited for us to find the right buyer. And I think another thing that the seller did really, really well on this that we struggle with is that he provided information almost instantly. Now, this was available here because he worked 4 hours a week. So he had nothing to do but respond to
Yeah.
diligence requests. And I get that that's not always the case, but I think sellers have to realize that this isn't, something I actually used this with my staff this morning. The buyer's not buying a business out of the vending machine where it's
Yep.
there, they just put in some money and it comes out. It's a lot of work on the seller's part. Now, we don't want that work to detract from the business in case we don't get to closing.
Yep.
But you're going to have to put in the time because one of the things that we always struggle with is the longer it takes to move buyers through the process, the more each party is likely to walk away.
Yep.
And it's not about forcing buyers too quickly down a road they don't want to go down, but it's giving them the information they need as quickly as possible to come to a decision.
Yeah, I mean, I've certainly been on the buyer side, and it's never a good look when you're waiting weeks to receive a financial report and you're thinking to yourself, this should be something that you can click and print out of your ERP and send a PDF immediately, right? And when it takes weeks, all you can think about, you're not thinking anything positive, you're not giving any grace to the situation. You're thinking about, oh my gosh, they don't close their books, for 3 months and it's full of junk and there's a bunch of skeletons in there and you're already discounting it, right? So, yeah.
No, 100%. I mean, not only does it take away momentum for the deal, but it makes you question their internal processes. And even beyond that, not only can they not pull this, were they able to pull it and they're playing with it behind the scenes, things like that. And quality of financials is something we can talk about for sure. But I think anytime you start seeing multiple errors in financials, like, oh, we have to take that, that wasn't actually a rent expense. That was $150,000 we had to pay for a lease termination, and that should be a one-off. Or, oh, accidentally, we understated our revenue by $70,000, $80,000, which at the 5X multiple, whatever, right? You
Yep.
start wondering, well, okay, once we see more than one of those, can we trust anything
Yep.
as a buyer?
Yep.
I think that may be a little too harsh, but that's what sellers should think.
Yep.
It's not just, oh yeah, we made a mistake, fix it, and then there's 9 others.
Yep. I mean, it's even just the nature of it that a lot of people talk about exit planning and how do you do value acceleration and how can you maximize the multiple on your company and all this and that. But I think one of the best things in the short term that you can do is just get your ducks in a row, that meet with a sell side advisor early on and begin to build what they call, for our audience, that data room, right? That you're putting a bunch of things in place and you're getting it ready. You're getting your financials uploaded. You've had your financials reviewed by outside parties to, have a third party perspective that's poked around and said, hey, tell me about this. Like, this doesn't seem clean to me, or this doesn't make sense to me. And, get your insurance policies uploaded, get your CPA reviewed financials, get your tax docs in there, get a lot of your documentation there and meet with your sell side advisor way ahead of time and begin to build that. So when you finally do go to market, that, okay, you can just turn stuff over as quickly as possible and it keeps that deal process going. And again, to this whole point, it doesn't create a poor perception from the buyer that, they're looking at as a risky endeavor. Like, it just makes it look so sharp when they ask and you do a 24 turnaround of information, or you just give them a Dropbox link and they don't even have to ask. Oh, it's wonderful, right? So,
And that's 100% correct. It makes you look very professional, and they're not going to be able to help it. Subconsciously, they're going to ascribe that to the rest of your organization.
yep.
Someone that is this prepared with this, I doubt they, whatever, I mean, I shouldn't make fun of payables, but I doubt they let the payables sit for 9 months, and forget about payables and things like that. And I think one of the things that we talk about is that the primary way you'll hear discussed, and probably the primary way in actuality that businesses are valued, is EBITDA times a multiple, right? So obviously you can grow EBITDA. That's one half, but the other part is, what is that multiple?
Yep.
And I did evaluation last weekend, and what you end up with, for sure, you can get a mean and a median. But what we really like to look at is sort of that interquartile range from 25 to 75% or so. And that'll give you a really good idea of where you fall. And if you say, okay, the range for the, make it up, it's 5.2 to 7.2. That's probably for a slightly larger company than the lower end of the lower middle market. But you can say, what influences that? And quality of financials is one of the really big things, because a lot of what's going on in that range is they're deciding how much risk is there to that earning stream going forward.
Yep.
And if you've got solid financials, hey, that's one less risk we can have to discount the multiple for.
Yep. So for our audience, like, I mean, the key takeaway, yeah, you can grow your bottom line margin, which increases your value, but it's also risk management, that in terms of passing on risk to the buyer, that you want to mitigate their risk and reduce their perception of risk of your business. And so the more that you can clean house, it's like you would a piece of real estate, right? That you swap out, the AC unit, or, you do some touch ups that, hey, make it look pretty nice. That same things have to happen in the business, right?
For sure. I mean, I think what buyers are looking at on that multiple is growth. Like we said, reliable cash flow, the
Yep.
confidence in those financials, key person issues like what we're talking about, owner dependency. Owners are very honest with me, in part because, and it's good to know, but in part because they're proud of what they do.
Yep.
But if you are the owner and you hold all the key sales relationships with your customers,
Yep.
that may not be viewed quite as positively by the buyer if you're not going to stay on post closing. And another big thing is customer concentration issues, and that's something that the more you can get out in front of, the better. And again, these aren't things that really drive the band of multiple you're in, but heavily influence where you are in that range.
Yep, totally. Yeah, I'd love to understand what specifically makes you want to work with the lower middle market. Like, what excites you and what gets you motivated versus, say, working with much bigger companies? What makes Sierra Pacific Partners and you, Scott, really want to focus on the lower middle market?
For sure. I think one of the things super interesting is a bit of a gap space as far as advisory services, right? I mean, you have business brokers. There's plenty out there that are doing mostly SBA driven deals in the sub 5 million in purchase price. And for sure, you have investment bankers doing larger deals where, depending on the bank, they start to get interested, typically around 50, 100 million. The bigger banks, maybe 500 million. Yep. But there's just not that much service that we see, I think, in the lower middle market. And so that's what sort of attracted me to that space. And I think the owners, it's still a space where you are largely talking to founder owners. For sure, we've done some things for what I would call smaller funds, but
Yep.
largely the folks that you're interacting with are involved in the business day to day, and they have these struggles with the issues that we're talking about. And I think helping them overcome them, or at least presenting them in a good light, but still, frankly, to the buyer, is important.
Got it. Great. What are, for our audience, for the business owners, what are some common misconceptions that you see most business owners have about selling their companies that our audience can make sure that they avoid?
It's interesting. I think one of the things that we see a lot is receiving an unsolicited offer and not running a process. I mean, that's a big decision, right? If you've got an offer that looks pretty good, do you want to pay somebody like me while you engineer a way to slow down the first bidder, right? So those are, you got a monetary consideration, and you've got a little bit of awkwardness there, and you're worried about, losing the one in hand for two in the bush, that
Yep.
that sort of that thinking. But that is a mistake that we see. And one of the things that we find is by running a process, you're likely to keep that first buyer honest. That may still be your buyer, but you're likely to keep them honest, keep them moving forward and generating better terms. And I think sort of in line with that, um, entering into exclusivity too early can be a bad thing, because basically you're still back with that one buyer and you don't really have a chance to test the market. And buyers do know, like, typically in the lower middle market, you're dealing with professional deal makers on
Yep.
the other side. They know that by the time you spent 4 months responding to their diligence request, you've racked up, tens of thousands of dollars in legal fees. There's a lot of momentum to
Yep.
keep going with that buyer. Now, I have seen sellers walk away for sure. I've seen sellers like, this is just getting crazy. They're at my bottom dollar. Now they want me to work twice as hard post closing than I do now. No, thank you. I'll just work for myself. And
Yep.
I applaud that candidly. But I think that's a mistake. Other sort of issues that I see are confidentiality. And one of the things that I think we talk about a lot in the industry that sellers don't realize is that confidentiality breaches tend to originate from the seller. I had a deal where the father was selling his company and the son didn't know. The father was giving a factory tour on a Saturday. The son saw him at a gas station near the factory on Saturday. And the father would never, ever be there otherwise. And the son figured it out. And so Monday we were putting the son under an NDA. But it's things like that,
Wow.
is
Yep.
realize that, you do that factory tour on Friday night. That contracted security guard, even though he's not your employee, he's probably friends with all your employees.
Yep.
So things like that. And we always default, keep the circle as small as possible,
Yep.
because deals fall apart and you don't want your employees to leave, get nervous, things like that. I think there's unrealistic valuation expectations. There's unrealistic expectations as far as timing. We sort of talked about that. I mean, for sure, if you've got a business in an industry that is popular, like everything else in life, there's sort of fads. HVAC is a fad right now, 100%. But if you've got an HVAC business doing 5 million in EBITDA, you got that data room built out, and you have a reasonable expectation as to price. For sure, we can probably sell that in 4 months. But as you move off those ideal sort of criteria or whatever factors, it's going to take longer. If you have that same HVAC business, but you want to get 20% above market price, well, that may take us a year to do. I also think sellers tend to focus a lot on the top line purchase price at the exclusion of how that price is paid.
Yep.
Sellers are generally pretty savvy that they don't like seller notes, but earnouts you need to think about heavily, and you need to think about rollovers heavily. And I think rollovers, the best thing I can tell you about a rollover is a good sign that you want to take the rollover is if the buyer does not care. If the buyer does not care, that means they're thinking this is the most expensive equity financing they can give you, that it's likely to work out. And then you may want to take it. We talk about this a lot. One of the things I had this conversation with a client this week is we're looking into the reputation of the funds. If the fund's a top quartile fund that has a record of very, very high performance, for sure, maybe you want to take that rollover depending on your personal circumstances. If it's a new buyer who's new to your industry that doesn't even have a track record in another industry, that may be a different conversation. But I think looking at the purchase price in the view of how it's paid and some of those other factors we're talking about, legacy, employees, and things like that matter.
That's a really interesting, note that you had there, that if they give no pushback in regards to the rollover, that it's fair game, that let's go. So I wouldn't have thought about that, but that makes complete sense.
And we're doing a deal right now where basically you have to take $1 million in the rollover. If not, basically we're being told by, our portfolio company acquirer that it's not worth the paperwork and the issues on our end if you don't take it. And so that sort of tells you they're a little bit indifferent as to whether you take it or not.
Got it. How do you suggest people balance? So you brought up the idea of, keeping a close circle and making sure that, there's confidentiality maintained. But how do you balance that? Hey, the buyer could be looking, especially founder-led company, et cetera. The buyer could be looking at some of the team members, and that saying, hey, I want those team members to carry over, that, these are essential team members that help build it to where it is today. I need them part of the growth. And if those team members hear of, this business selling and it's a surprise to them and they weren't communicated about it, that there's risk, there's the flight risk, that they say, I'm scared of what's to happen and who's going to be the owner, that I'm out, and that risk associated with it. How do you suggest that, sellers balance that of, keep the close circle so that there is confidentiality, but at the same time, you don't want flight risk of employees that get spooked by, something that does pop up somewhere?
Oh, of course. And candidly, that's the buyer's issue too. Like,
Yep.
so the
Yep.
buyer is generally, as a closing condition, going to make key folks sign retention agreements. And that's totally okay. And you as a seller probably are going to want your key people to know.
Yep.
But what I would say is, we typically do all the other, or almost all the other negotiations first before we then preview that with those key employees. Sometimes then you'd put those key employees under NDA. But I think more generally, the dynamic here really depends on what the seller's going to do and the team. And what I mean by that is, look, particularly in a true like venture back type startup, everybody knows the startups, fundraising all the time, looking for a deal all the time, trying to IPO all the time. So it's not really as much of an issue. And one of the reasons why is the expectation there is that the CEO, the person who's probably our owner in this case, is going to stay post-closing, right? And so that makes a huge difference.
Yep.
If the whole management team, including the owner, is going to stay post-closing, most likely the employees are going to be a lot less skittish. If they're going to leave, you have to be careful how you handle that. And I would say my general experience for the buyer to be happy in order to massage this is typically you should not introduce the buyer's team to your employees at the same time as you announce the transaction. I've seen that go wrong before. It's generally good to let them know that a transaction is happening, have them feel comfortable about that, let them digest that for a couple days or a week before you bring in the buyer's team. But it is 100% good to bring in the buyer's team so they can get comfortable with them. Again, though, all these things towards as late as you can get away with socially in the process.
So Scott, one of the things I always hear, there's different exit options that, right, you can even, a trending theme is ESOPs now. You can exit to a private equity buyer. You can exit to a strategic buyer. You can exit to somebody just looking to, entrepreneurship through acquisition too, right? There's all different types of buyer profiles out there. And I get the usual saying, the right buyer profile is dependent upon, certain circumstances of what you're looking for, in terms of your exit, how much you want to get paid, et cetera, what legacy you're wanting to leave. So it really does depend upon your particular context. But I am interested that, you're working the space. Is there a preference that you tend to see that it's like, yeah, this is usually the best way that we find that lower middle market businesses should consider exiting? Or do you really feel like it's really is highly context dependent? What's your experience?
It is context dependent. Obviously, as an M&A advisor, I'm focused on third-party M&A, right? But there's definitely other solutions, transfer to family, ESOPs we see. A management buyout can be akin to third-party M&A in certain circumstances. But I think when we start talking about buyer profiles, it definitely depends on the context. But what I will say that makes the lower middle market interesting is it's historically been a no man's land, because we're talking about companies that are too big for individuals. We can put an asterisk on that and talk about it in a minute, but are also too small to get corporate strategics involved. So, although we all love to deride private equity for driving hard deals, they're really what's created liquidity in this market, because that's who will come in. They can write checks through their financing without getting extra, traditional financing or SBA financing, and drive deals. Now, on the lower end, that's changed a little bit. You can get SBA financing, I think, up to 5 million, and pari passu maybe takes you up to 10. So that bites off the very lower end. But once you get above that, we're generally talking about private equity. And for a lot of these companies, we're not talking about what we would refer to as platform investments. So that would be a fund deciding, hey, we want to get into healthcare services. There's a radiology group in Orange County that we're going to buy. We're talking about add-ons for the most part. So in other words, they buy that giant, radiology group, and then they're looking at a smaller radiology practice with 15 physicians. That's an add-on. So a lot of the buyers that we're talking about are actually strategic buyers, but they're smaller strategics. They're private equity-backed strategics. Yep. And so we see that quite a bit. Search funds are for sure an ETA, a big part of the market. However, there's huge distinctions, right? Like a traditional search fund that's funded, they're typically doing deals sort of above that, I think, above that individual purchaser range, but not quite on the higher ends of this. But they can be bigger. Search funds can mirror many private equity in context. But I think really it's looking at those categories, thinking what makes sense, and targeting who you think would be a fit for the company. And that's part of my job. Part of what we do is we get a sense from the owner based on their confidentiality concerns. How broad of an outreach should we do? Yep. Should we get up on Axial and list the business, even on a no-name basis? Or do they, want us to iteratively reach out to different 5 to 10 buyer groups? And those are very different processes.
Got it. Well, thank you for that. Well, Scott, to wind up our podcast here, our episode here, that we ask every guest that comes on this show, what's the number one takeaway, the number one piece of advice you give to CEOs, to owners in a lower middle market who are looking to accelerate their company's growth and create value?
Well, obviously to grow, from my perspective, to control that EBITDA portion of the multiple. But I think more realistically on our end, making sure your financials are solid. If you're in an industry where you're on cash basis, but it's not a cash basis industry for whatever reason, convert to accrual. If you can get those financials reviewed or audited, depending on where you are in this market, I think that makes a lot of sense. That is the most important thing you can do.
And running a CFO firm, you just spoke to my heart there. So thank you, Scott.
You're welcome.
Yep. Yeah. Well, thank you, Scott. Really appreciate having you on the show. And thank you so much for the insight that you've given to our audience in regards to how to exit well, how to prepare for these sales, and what to think about. So thank you so much.
Awesome. Thanks so much for having me. Really appreciate it, Mason.
Awesome. Thanks. Well, thank you, everybody, for listening to this most recent episode of Accelerating Lower Middle Market Value. We hope that you found actionable insights that you can implement today to accelerate your business value. Wanted to give a shout out to our sponsor, Brady CFO. Brady CFO is a team of CFO advisors that help business owners in the lower middle market build the business of their dreams via comprehensive growth strategies and financing that growth. If you'd like to learn more about Brady CFO advisory services, visit bradycfo.com. Thanks, everybody. Until next time.